This is Liam, and today on the Infographics Show 13, we're diving into a huge question: why OpenAI might run out of money. But not for the reason most people expect. At first glance, the company behind ChatGPT looks like the ruler of the tech world, pulling in around $20 billion in revenue. Sounds unstoppable, right? But leaked internal projections show something shocking. Starting in 2026, OpenAI could face losses of around $14 billion every year, and it doesn't stop there. By 2029, total spending could climb to nearly $115 billion. The technology clearly works, but the costs behind it are tied to very real limits in the physical world. Here's what many people overlook. Artificial intelligence isn't just another piece of software. It behaves completely differently from the apps and programs we've built for decades. In normal software development, if you want a better product, you hire skilled engineers and write cleaner code. The costs mostly come from human work. But AI doesn't follow that rule. Instead, it follows something researchers call scaling laws. These are mathematical patterns that describe how AI improves, and they come with a massive price tag. The rule is simple but brutal. If you want an AI model to be twice as capable, you can't just double the effort. You often need many times more computing power. It's basically brute force math. Small improvements in intelligence demand enormous jumps in hardware and energy. It might sound wild, but the numbers are even crazier. Training GPT-4, the model that pushed AI into the mainstream, reportedly cost about $100 million in compute power. That's just for a single full training run, the process of teaching the model from scratch. For a giant tech company, that's manageable. But the next generation of AI models, expected around 2026 and 2027, plays on a completely different level. A single training run could cost over $1 billion. Think about that. One training session for one AI model could cost more than the entire yearly economy of some small island nations. And the situation gets even tougher. You don't train the model once and walk away. These systems must be retrained, updated, and improved again and again. That traps OpenAI in a cycle where they must keep spending billions just to stay slightly ahead of competitors that sometimes release similar technology for free. That creates a serious problem in the business model. Their expenses are tied to physical realities, electricity and silicon chips, both expensive and limited. But raising prices isn't easy when competitors are everywhere. The math becomes scary fast. Costs are exploding while revenue struggles to keep up. And the money drain gets even worse when you look at the hardware powering everything. To run these systems, OpenAI needs powerful AI chips like NVIDIA's Blackwell B200. These are not typical computer parts. Each chip can cost $30,000 to $40,000, and companies don't buy just one. Training a top-tier AI model requires huge clusters, tens of thousands of these chips linked together with ultra-fast connections and advanced liquid cooling. That's where spending really starts to skyrocket. But the challenge isn't only buying the chips, it's how quickly they become outdated. A factory machine might last 20 years. A delivery truck might run for decades. AI hardware is different. The moment a faster generation appears, the previous one loses value. To stay competitive with companies like Google and Meta, OpenAI may need to replace huge portions of its hardware every 18 months to 3 years. Imagine running a trucking company where you must buy a brand new fleet every year and a half because the old trucks suddenly can't keep up. That's basically the economic reality of AI infrastructure. So the billions spent on hardware aren't long-term investments. They're costs that disappear quickly. And if the chip costs weren't enough, there's another bill getting bigger and scarier: the electricity bill. One of the clearest examples is Project Stargate. On the surface, it sounds like just another giant supercomputer, but the scale is unbelievable. The project has been discussed as a potential $500 billion investment. Yes, $500 billion. To understand the scale, the system could require around 10 gigawatts of power. That's enough electricity to run millions of homes. It's comparable to several full nuclear reactors operating just to power AI systems. Why does this matter so much? Because these energy demands aren't temporary. The next generation of AI requires this level of power. The costs don't simply disappear. And another problem appears: the power grid itself. Electrical infrastructure can't expand overnight. Building enough high voltage transformers and grid capacity takes years. So companies like OpenAI are now exploring deals for direct access to nuclear energy and giant solar farms just to secure enough power. All of this creates a very high baseline for operating costs. Every free ChatGPT user actually adds to that expense. Serving hundreds of millions of people while offering a free version makes it extremely difficult to maintain healthy profits. Every time someone asks a question, electricity is consumed. So if OpenAI is burning billions on chips and energy, how does the company stay alive? How do they pay employees and keep the lights on? This brings us to Microsoft. We often hear headlines saying Microsoft invested billions into OpenAI. On paper, that sounds like huge piles of cash flowing in, but the reality is more complicated. Much of that investment comes in the form of cloud credits rather than traditional cash. Think of it like a massive gift card. OpenAI can record it as funding, which makes their finances look stronger, but those credits can only be spent on Microsoft's Azure cloud services, so the money often circles right back to Microsoft. This setup boosts Microsoft's cloud business and strengthens its stock performance, but there's a major catch: you can't pay employees with cloud credits. When OpenAI hires a top researcher earning $2 million a year, they need real money. Office space, legal fees, and salaries all require cash. So while billions may appear on paper, the startup still needs constant outside funding to cover everyday expenses. If outside investors slow down, they face a crisis. They might have plenty of computing power, but not enough money to keep their team. Even with those risks, investors keep pouring money in. In March 2025, they raised $40 billion. That's even bigger than the famous IPO of the oil giant Saudi Aramco. But here's the strange part: Saudi Aramco earns hundreds of billions and owns physical oil. OpenAI, on the other hand, is still a startup losing billions each year. Much of its value comes from intellectual property, something competitors can attempt to replicate. So why are investors willing to gamble so much money? Because they believe in a future market that doesn't fully exist yet? For OpenAI to eventually be worth $1 trillion, its technology would need to replace dozens of tools businesses already use. But today, companies spread their budgets. OpenAI is building something powerful and expensive, betting everyone will need it, but many successful software companies survive by making it difficult to leave. OpenAI is learning a harsh lesson. AI users are extremely flexible. If another model gives similar answers for less money, people can switch instantly. About 75% of OpenAI's revenue currently comes from consumer subscriptions, but cancellations have started rising. Once the excitement fades, many casual users stop paying. Large corporations are cautious too. Only about 20–30% continue using OpenAI's API long term. Many companies prefer open source models like Meta's Llama, because they offer lower costs and greater control over private data. Without strong lock-in, customers can move to a different AI provider almost overnight. And the competition is intense. When Meta released its Llama models for free, it wasn't charity, it was strategy. Meta effectively placed a ceiling on what others can charge. Meta can afford to do that because its real business is advertising. AI simply helps improve ads on Facebook and Instagram. OpenAI doesn't have that advantage. Their entire business depends on selling AI itself. Meanwhile, pressure is coming from every direction. Above them are giants. Below them are lean startups. Companies like Anthropic focus on reliability. At the same time, Google DeepMind continues attracting top AI talent, forcing OpenAI to offer huge stock-based compensation. Those packages only work if the company's valuation keeps rising. If growth slows, top researchers might leave, and talent is the company's most valuable asset. And then there's the growing attention from regulators. In early 2026, authorities in the US and EU increased antitrust investigations into the Microsoft OpenAI partnerships. Regulators want to know whether Microsoft's investment effectively gives it control without formally acquiring it. If governments decide to limit that, they lose a lifeline. At the same time, global tensions are adding more challenges. Export restrictions on advanced AI chips are shrinking potential markets, while new AI safety laws require expensive compliance teams filled with lawyers and researchers. Those rules cost money, but don't generate revenue. History shows that companies can survive years of losses. Uber burned billions building a network. Tesla struggled while constructing factories and charging stations. Those were physical systems competitors couldn't easily copy. OpenAI's situation is different. Its product depends mostly on raw computing power, and each complex query costs money to process. Unlike those other companies, users can switch to alternatives quickly. Because of this, OpenAI is betting everything on one bold timeline. The company is racing to build artificial general intelligence, often called AGI, a system capable of performing intellectual tasks at or beyond human level. If they reach that breakthrough first, the current spending might suddenly make sense. Such a system could perform the work of experts across many industries, from writing advanced code to planning complex business strategies. If that happens, the revenue potential could be enormous, but the clock is ticking. Losing $14 to $17 billion per year means every month of delay costs over $1 billion. If AGI arrives in 2 years, investors might celebrate. If it takes 5 years instead, the company could face a funding gap close to $100 billion just to keep operating, and no investor can solve that instantly. So what happens if the money eventually runs out? The most likely scenario isn't a dramatic collapse or bankruptcy headline. Instead, a quieter outcome is possible. By around mid-2027, the cash from recent funding rounds could be running low. At that point, OpenAI might face a choice: raise more money or sell. The most obvious buyer would be Microsoft. Microsoft already runs OpenAI systems on Azure and has deeply integrated the technology into its products. With more than $80 billion in cash reserves, Microsoft is one of the few companies capable of sustaining such massive spending. For Microsoft, it's a key technology. For investors, it might look like a fire sale, but one that keeps the technology alive. In many ways, this marks the end of the small startup phase of AI development. OpenAI proved that scaling works, but only with budgets that resemble those of entire nations. The race has become an industrial competition. OpenAI started the revolution, but competing alone at this scale may no longer be possible. The future of AI is being built in data centers and power plants. What do you think? Is AGI worth the $500 billion price tag? Subscribe, hit the bell, share this briefing, and tell me in the comments. I'm Liam, and I'll see you next time.